let's explore the fascinating relationship between the government and the economy in our discussion today. We'll see how government policies directly shape markets and significantly impact our daily lives. First, let's define what government regulation truly means and why it's so important in society. Regulation involves rules and laws set by the government to control business operations, ensuring fair practices and protecting consumers. It's crucial for a stable and ethical marketplace, preventing failures and ensuring public interest. We'll now dive into the four main types of regulation that guide various aspects of business and society. These types serve to guide and manage different, crucial aspects of both business operations and broader society. Our first type is economic regulation, which directly influences market behavior and structure. This type controls prices, competition, and how businesses enter or exit specific markets. For example, consider the tariffs that regulate the telecommunication sector's pricing. Next, we have social regulation, focusing on the well-being of the public. Social regulation aims to protect public health, ensure safety, and safeguard our environment effectively. A great example is the Environmental Protection Act, crucial for our planet's health. Then there's financial regulation, vital for the stability of our economic systems. This ensures stability and promotes transparency within our complex financial systems. Think about the Reserve Bank of India's banking rules, which govern financial institutions. Finally, we examine administrative regulation, which covers the operational aspects of businesses. These are the rules for legal operation, including essential requirements like various business licenses. For instance, obtaining a business operating license is a clear administrative regulatory requirement. Let's explore the core objectives behind government regulation and its fundamental purposes. These objectives are designed to protect society while fostering truly fair and equitable markets. One key objective is to protect consumers, ensuring their safety and fair treatment. This means ensuring that products and services are safe, reliable, and meet expected standards. Another crucial objective is to actively maintain healthy competition within industries. This involves preventing monopolies and combating any anti-competitive practices that might arise. Regulation also aims to promote broader social welfare across the entire population. This includes supporting vital environmental protection efforts and upholding essential worker rights. Lastly, a significant goal is to ensure overall financial stability within the economy. This means regulating markets carefully to prevent financial crises and maintain confidence. Now, let's shift our focus to understanding the concept of deregulation and its implications. Deregulation means reducing or eliminating government rules on businesses, aiming to boost competition and foster innovation. This can lead to greater efficiency, lower costs, and new market entrants. Let's compare the impacts of regulation versus deregulation to understand their trade-offs. We will carefully weigh the distinct benefits and potential drawbacks of each approach. First, let's consider the various impacts that government regulation brings about. Regulation protects consumers and plays a vital role in ensuring fair trade practices. It also prevents environmental damage and actively works to enhance overall social welfare. However, regulation can sometimes increase business costs and potentially stifle innovation. It can also, at times, lead to bureaucratic inefficiencies within the system. Now, let's turn our attention to the impacts of deregulation on the economy. Deregulation often encourages competition, resulting in lower prices and improved services for consumers. It also tends to promote innovation and significantly contribute to overall economic growth. However, it can potentially lead to market failures or even reduced consumer protection. There's also a potential for environmental harm if regulatory standards are significantly lowered. Today, we'll explore the delicate balancing act between government regulation and deregulation in an economy. Our aim is to find that sweet spot, the perfect balance for fostering a truly healthy and vibrant economy. First, we need transparent frameworks, meaning clear and understandable rules for everyone to follow. These frameworks involve clear, fair rules that encourage compliance and adapt to changing economic conditions. Next, gradual implementation is key. Changes should be introduced slowly to allow markets to adjust. Introducing changes slowly helps markets adjust, allowing us to monitor for any unintended consequences effectively. Finally, stakeholder engagement is crucial, involving all parties affected by these important economic decisions. This means involving businesses, consumers, and civil society to create truly inclusive and balanced economic policies. So, let's start by defining a fundamental concept. What exactly is taxation in an economy? Taxation is how governments collect money from individuals and businesses to fund public services and achieve economic goals. Now, let's explore the difference between direct and indirect taxes, especially in the context of India. We'll see how these distinct types of taxes impact both individuals like you and various businesses. First, let's look at direct taxes, which are quite straightforward in their application and impact. These taxes are levied directly on your income or a business's profits. For instance, common examples include income tax for individuals and corporate tax for various businesses. With direct taxes, the person or entity paying the tax directly bears its burden. Now, let's shift our focus to indirect taxes, which work a little differently, as you'll see. These taxes are levied on the goods and services you purchase, not directly on income. Key examples include the Goods and Services Tax, or GST, and customs duty. Indirect taxes are often passed on to consumers, becoming part of the product's final price. Let's delve into some key concepts within the fascinating field of environmental economics. Our goal here is to truly understand the crucial link between economic activities and the environment. First, we have externalities, which are the hidden costs or benefits of economic actions. These are unintended positive or negative consequences of economic activities affecting third parties. Next, we consider public goods, which are essential environmental benefits available for everyone. These include non-excludable and non-rivalrous benefits like clean air and rich biodiversity. Then there's market failure, a situation where free markets don't account for all costs. It occurs when markets fail to account for environmental costs, leading to inefficient resource allocation. Finally, sustainable development is about meeting our present needs responsibly without compromise. This means meeting present needs without compromising future generations' ability to meet theirs. Let's now recap the key points we've covered in this discussion on government and the economy. Here are the essential takeaways, important concepts for you to remember from our lecture. Remember, regulation ensures fair practices, protects consumers, and maintains financial stability in our economy. Deregulation, conversely, aims to boost competition, innovation, and economic growth by reducing government controls. Finding a balanced approach between regulation and deregulation is crucial for a healthy, dynamic economy. Taxation, as we learned, funds public services, redistributes wealth, and influences economic behavior. Environmental economics crucially links economic activity directly with ecological sustainability and well-being. Ultimately, effective policies balance economic growth with environmental protection, ensuring long-term prosperity for all.